Do you think the market will continue to be volatile?
You typically have a higher chance to make money by being invested into equity when volatility is high than when volatility is low.
So what do you think are the growth drivers of emerging markets coming from?
Emerging markets are likely to be initial beneficiaries of this transition.
In particular, do you still maintain overweight on Chinese equities?
I do believe that it's a good time for long-term investors to be contrarian and to be investing ahead of some of the improvements that we are likely to see starting in the second half.
今天我们请到普莱士亚太区多资产解决方案主管 Thomas Poullaouec 来解读一下资产配置策略。Mr. Poullaouec, thanks for joining me.
Thank you, Anu. Thank you for having me.
Many investors think it's harder to make money this year than it was last year for many reasons. First of all, many central banks started tightening monetary policies this year, and also the situation between Russia and Ukraine complicates the macro environment. But according to your report, your forecasts for most active markets are comparable to or slightly more bullish than they were at this time last year. Why?
I would like to put a bit more context around our report, which is called the capital market assumptions. It's a 5-year forecast, so it's not necessarily for the next 3 months, of course. So we do an annual review of different indicators that are inputs to an equity and fixed income forecast. And some of these indicators are related to inflation, to economic growth, and also take into account some of the developments that we have seen during the pandemic around stimulus, fiscal stimulus in particular, as well as deglobalization. So when we factor in all of these inputs, we found that our investors at T. Rowe Price were factoring more a higher inflation outlook going forward compared to in the past. So higher inflation will filter into a higher return forecast for equity, but a lower return forecast for bonds.
The global market fluctuated sharply in the first quarter. Do you think the market will continue to be volatile?
I think the next decade, we will see higher level of inflation, as I said before, higher level of yields, and that typically is also accompanied with higher level of volatility. So I do expect volatility to stay with us. It will come and go, but structurally it will be higher than what we had before. So investors need to embrace volatility rather than to try to avoid it at any cost. Because what you were telling me as well is that there have been a lot of shocks to the economy in the first quarter. And what I found is that some investors have become too pessimistic. Our research shows that when you have higher volatility, and if your time horizon is 1 year or above, you typically have a higher chance to make money by being invested into equity when volatility is high than when volatility is low.
So what sectors in the equity market do you prefer?
We maintain what we call an overweight to the value style versus the growth style. So value style tend to be heavily dominated by one sector, which is financial. So we do see that with rising yields, banks could improve their earnings. And we expect that this could be not only in the next quarter, but could be a medium-term story. So improvement in financial sector earnings. And the second sector I would point towards, which is related to our view on inflation, there are certain companies where they can grow their earnings when inflation is moving higher. And that will be, for example, natural resources stocks. So materials, energy companies, where they can increase their earnings when prices are moving higher. And it tends to be a good hedge against inflation, especially what we would call unexpected inflation, like what we are experiencing these days. And the second subsector of these real assets will be REITs. So REITs tend to improve their earnings when inflation is moving higher, because they can renegotiate lease and rents are moving higher. So we could say that typically REITs can improve earnings with a couple of quarter delay to the inflation cycle.
You give emerging market equity an 8.3% 5-year annualized expected returns, the highest among all asset class. So what do you think are the growth drivers of emerging market coming from?
And I would say that there are two drivers that are higher for us in emerging market going forward. One is the inflation that could stay higher in emerging market than in developed market. And the second one is valuation. In developed market, valuations were quite extended, so leading to some contraction and negative return impact in developed market. But in emerging market, valuations are more modest. So we could see even an increase in return due to improvement in valuation. So these are the two drivers that are leading towards a higher return number for emerging market compared to developed market. And I would say in terms of fundamental drivers in the growth outlook, I will point towards two things. One is that emerging markets have been changing quite materially in the past decade, and there are a lot more growth companies. So if you think about the tech sector, these are companies that can drive innovation and drive productivity gains in emerging markets. So automation is also something that we see a lot of improvements in emerging markets that can lead to higher earning growth. And the second driver would be also the transition that the world is going through to deal with the big challenge of our generation, which is climate change. And there are a lot of changes that are happening in the world in the way that we consume commodity, and that we need to make changes in the way we produce energy. So I would say that emerging markets, especially at the beginning, could be a big beneficiaries of these changes, because to, for example, produce an electric car, you need access to a lot of materials, raw materials that are coming from emerging markets. So copper, for example, lithium, and so on. So I would say emerging markets are likely to be initial beneficiaries of these transitions that could lead again to future and better earning growth in emerging markets than in developed markets.
In particular, do you still maintain overweight on Chinese equities?
I do believe that the efforts of stimulus that are putting forth by cutting rates, by also focusing on the consumer in China to try to alleviate some of the pain points of higher inflation, I think that will create a better economic environment, given that it's quite a cheap market these days, and expectations are very low towards the Chinese markets. I do believe that it's a good time for long-term investors to be contrarian and to be investing ahead of some of the improvements that we are likely to see starting in the second half. So I do believe that there are also very attractive opportunities in China in the tech sector, because prices have been going lower. There could be recovery in these companies. So we do own quite a large chunk in these companies as well. And there are also, I think in China, what is very interesting to me is the number of stocks that might not be, so I'm not talking about the mega caps, but more the small and mid cap companies, which are perhaps under-researched, and where there are a lot of innovation going on and a lot of growth that could come from the small and mid cap.
Do you have any investment advice to investors?
I would say for investment and asset allocation is diversification, diversification, diversification. So you have to remain diversified in your portfolio. You have to remain also invested because I think there is a tendency by some investors to be very tactical and try to employ market timing in their portfolio, but market timing is hard. And there are research that shows that over the long term, your strategic allocation, so your long-term diversification, is the main driver of risk and return in your portfolio. And market timing, or what we call tactical acceleration, is quite limited in terms of long-term impact to your portfolio.